Is there a need to ration even more demand? That's one of the issues we are going to discuss with Mike Zuzolo, the one and only president of Global Commodity Analytics. Right here on Connected Farmer, your channel to keep you up to date with the latest trends in agriculture and livestock. Stay tuned and don't forget to subscribe. Mike, how are you today? I want to hear your word first on the USDA stocks report.
Well, it was a complex report. Clearly, another surprise like last year's stocks report. I think that after looking at all the data, Luis, clearly the corn was the biggest surprise. Soybeans were a little bit of a surprise, but not a lot of a surprise. And it was supportive for soybeans and it was supportive for wheat, but for the corn, I think it blew the doors off of the bears, and they really are still scratching their head trying to figure out how the USDA came up with this number. And I think that is very important to keep in the back of your mind as we go through harvest here in the northern hemisphere and as you pick it up in the southern hemisphere with planting, because we have to know at this point that USDA did not cut production of corn to get to this sub 2 billion bushel, what will be the ending stocks number for the 2019-2020 marketing year, or close to 2 billion bushels. They essentially went to the feed and residual column, which is a catch-all. It's a bucket. It's what's left over to fit the number that they essentially want to use for carryover. That's how I look at it. And because I look at it that way, I'm very suspect when numbers are moved like they are in this way, in this fashion. So my takeaway from this report is that the corn especially, the market has been given an opportunity to go back up and check the old highs, that we can ration demand. We need to ration demand, as you asked the question, especially if weather in the wheat belt of the United States and Russia and the corn and bean belt of Argentina and Brazil continue to support lower production. And so we've got a window of opportunity here, I think, for higher prices, or at least to go up and double check those old highs, as long as we don't have some kind of negative demand shock by China or someone like that. Plus, between now and the October USDA crop report, which is now just less than 10 days away, you don't have to worry about the election. And so I think we're on a very short timeline, as we would say, a short leash for the rally to continue, and to put hedges in place and to continue to sell and defend. That's my motto. It has been all the way through 2020, and it's going to be that way through 2021. Why? Because we don't know when the weather markets will end. We don't know when the weather will change, but we do know profitability. And a producer in the United States who can farm 60 bushel acre beans and get a $10 cash price gets $600 of gross revenue per acre. If you can do that each and every year, you're not going to go broke. Similarly, if a producer can get 180 bushel yield corn at $4.15 cash price, that's $750 an acre. You're not going to go broke making a profit. So sell it and defend it, because we don't know when the weather market's going to end, and have that defense in place. I think if producers would have done that in 2020, they'd be sitting a lot better than they are right now. So learn from 2020 and do that in 2021.
And what are the best hedges right now in early October?
Yeah, this is a difficult answer to give you, because we don't know in the aftermath of this grain stocks report whether the cash basis will fall or whether it will rise, because the futures market, when it typically goes higher into harvest, counter seasonally, the commercial elevators, especially the ethanol producers, under these kind of circumstances we're under right now, will widen out the basis, will make it worse to compensate for the futures rally. And so I really have to address that on a one-to-one basis right now. I talked to a client near the Indiana-Ohio border today, and his biofuel ethanol plant has gone essentially from a plus 40 basis on corn, 40 cents over the futures market, to a steady or zero basis with the futures market in just the past 2 or 3 weeks. So this is indicative of the pain that the ethanol market's still feeling. We saw the ethanol production drop again pretty substantially this week. We saw Marathon Oil lay off, I believe, 12,000 people in the United States. They're the largest refiner in the United States, and that's going to impact negatively the ethanol industry and the biofuel industry as a whole. So we really have to pick and choose whether we sell off the combine with the cash or whether we do a futures only contract. Obviously, if you don't have the bushels to store the corn or the beans on your own farm, the forward contract or selling right off the combine is less risky.
Yes, and as we speak, we are having an unusual delay for planting in the state of Mato Grosso in Brazil. This state is very recognized that the no drought state, and now we are having drier than normal weather in Mato Grosso. And yet I spoke to an analyst in London, and he told me that the Russian wheat crop could get up to 20 million metric tons smaller than previously expected. How do you analyze these outcomes?
Yeah, the Black Sea region is a real issue for the wheat crop. And look at what we're dealing with here in the United States. The USDA came in with a much lower production forecast because of lower acres on the grain stocks report and the small grain summary, but they're not low enough, in my opinion. I'm below a 50 bushel yield here in the United States for all wheat. If we don't get rain between now and December, I will take it below that level even. And I think between Russia, the Ukraine, and the United States, you've got enough issues with the wheat market that it continues to be, to me, the weather leader and the overall trend leader to the upside or whichever trend we take. I think it's really important to realize, too, when you talk about Mato Grosso, I wonder whether that's the same drought, even though it's so much farther away from Argentina, whether that's the same drought that we're experiencing so dramatically in Argentina. And I was very surprised this week to hear, just as we go on the air on this day, that Argentina's government is looking at cutting their export tax on soybeans, agricultural exports, especially soybeans, from 33% to 30%, in the hopes that farmers will let loose of some of those bushels that you and I have been talking about they're storing. I find that to be a very dangerous game. I know the Argentines need the income, but what if this drought doesn't go away and they have a very low production for this next year's crop? They're going to probably want those soybeans in 6 or 9 months for their livestock industry. This is why the defense in the sell and defend model is so important.
And what is said here in Argentina is that the problem is not the soybeans or the dollars. The problem is the Argentine peso. So I don't think this reduced taxes would give an incentive for farmers to sell significantly.
I was going to ask you about that because I was reading that the Argentine dollar demand is so high, they don't even call it a black market. They call it a blue market because so many people are using it right now. And even though it's illegal and it's a black market, there's really no other way to be able to exchange and be able to live. Does that sound accurate?
Yes, for a long time, it's been something that has been deepening in the Argentine culture to use more US dollars.
And so this goes back to the commodity issues of what Venezuela has dealt with, where they were such a large oil and copper exporter and producer and put so much of those minerals and energy supplies onto the global market. And they're not really doing that to the extent they used to, one, because they can't fund themselves, and two, because of sanctions. I know Argentina is not likely to get sanctions, but this is something in the longer term that if Argentina continues to erode economically and physically default again, we've got to wonder whether they're a true reliable supplier of some of these grains and oil seeds and meats. I know that agriculture is their way out of they export their way out of debt because of the GDP is such a large percentage. But even in these kind of circumstances, I think farmers and ranchers need to realize this is a very serious situation that doesn't come around except once about every generation, in my opinion.
And actually, President Trump gave a call to the president of Argentina, Alberto Fernandez, to stop these currency controls because there can be a bigger controversial and panic in the region.
Yes, it could open up the South American and foreign and trade policies are so closely linked nowadays. I think that's a really good point to make.
Yeah, and it's interesting because the U.S. election is going to have a huge impact, not just over the U.S. dollar, but if you watch the debate this week, Biden talked about possibly having some trade threatening Brazil, some trade issues, and threaten Brazil if does not control deforestation.
Yes, I think this is where the green policy comes in. And, you know, I've had several calls from producers on other media here in the United States, and they don't like the idea that I'm talking politics. And they think I'm being political, and I'm really not. I'm truly not being political here. This is a true currency and energy intense election that we're going to have. And we saw that immediately after the debate up here. One of the major banks in the United States, or I should say one of the major world banks, wrote a note to clients after the debate and said, we would recommend buying gold in case there is a contested election and we don't have a new president-elect by November 4th. I don't think the world understands what this could mean to the financial markets. And that's why, if for no other reason, I think the hedging for the profit after this grain stocks report and the hedging for profit in fat cattle and in hogs now that they've rallied so sharply, it's extremely important to keep that in the forefront of your minds, that these black swans, these historical things can happen. They do happen. And when countries are in the middle of a pandemic and they're underneath extreme debt loads, they tend to happen more frequently. And we tend to forget them as a marketplace. And I think it's a really, really key point this next 35, 40 days to keep in mind. If you want to get bowled up on a Brazilian drought, fine, sell it and defend it.
Yes, and I wanted to ask you about the meat market. I read that a lot of facilities in the U.S. are automating its processes, and some lawmakers are boosting local production. How do you see
I mean,
it?
it's keeping us current on our marketings, and that's a good thing. I have seen concentration in the agriculture industry in almost 26 years I've been doing this, and I don't like it. I know it makes prices go down in terms of makes it cheaper for the consumer, but I think at some point you're going to pay a price for that. I think we saw that in the supply chain, and this automation that that the meat packers are working on right now, the artificial intelligence and the automation with machines, and sometimes in some forms that is good because you don't have one human being standing for 12 hours straight in a very tough job that is very, very hard on you as you go through your work life and your career. But in other ways, you are going to take away, I think, the ability of a good, strong earning potential in some of these industries is in agriculture as we get more and more artificially intelligence utilized and more automation takes place. And some would say that it makes the supply chain less fragile. I would argue the opposite, because the more you rely upon automation, the more you rely upon automation, and you can't get off of the automation kick very easily with the type of investment we're seeing. And that's exactly what happened in these supply chains, where these major, big, massive machines were making restaurant grade sizes for meat cuts and cheeses and milk products. All of a sudden the pandemic hit, restaurants shut down, and they need to go to grocery stores. The smaller firms with more people were able to adapt faster than the larger firms were. So I think there's a give and take there. I'd say generally speaking, it's not going to end up being a good move long term, but here I am, a small commodity broker, in Atchison, Kansas. What do I know?
Is this going to benefit the farmer, or do you think there will be minimal impact for the farmer?
I believe the more vertical integration that we have, the less price transparency that we will have, whether you're talking about machinery or whether you're talking about where you sell to. It's all about transparency, and it's all about opaqueness in the markets. And the more transparent you are, the better for the producer. And the less market share or profitability is taken for only one or two segments of the supply chain. The more transparency, the more even the profitability, in my experience.
You talked a lot on this edition about the energy markets because of the election. But some locations are cutting production. How do you think that is going to be running until the end of the year?
Well, till the end of the year, it's going to be very, very difficult because we here in the United States can't get our Congress to supply another fiscal stimulus specifically for airlines and very energy intensive companies and industries. And these are industries that, like agriculture, are very capital intensive and very labor intensive. And so once you lose an airline, you're not going to get it back the next year. That's the thing about this, what we're going through this pandemic. So I see demand for energy being weaker. I did lock in and recommended locking in energy needs for the fall harvest for up here in the Northern Hemisphere because refineries are cutting back so much. I don't think the cash prices are going to fall that much more, Luis, but futures markets are going to get more volatile. And I think the downside potential could be quite a bit more because our demand's weakening as we go into the end of the year without more stimulus. After the first of the year, if we would get back to around $20 or $25 a barrel in crude oil prices in West Texas Intermediate and New York futures, I think that would be an equilibrium price. So somewhere around $20 to $25 a barrel, I think we'd find some support. It may take a while though, depending on what OPEC decides to do.
Mike, thanks a lot.
Nice to be with you again this week, Luis. Thank you for having me.